Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Hey, let me check. What day is today? Oh, turns out it's Saturday, right? So, welcome back for another weekly market recap. And it was kind of a quiet week if you were betting on some sort of a directional move for markets in general. Like, just as an intro, we've seen the equity market trying to put together a bounce, but not really going anywhere at the end of the week. We've seen Bitcoin still a bit weak, but not really breaking or cracking new lows, and at the same time, not making new highs, so not fully recover last Friday's dump. And, we're going to take a look at the other markets, but as a general rule of thumb, those markets where you would expect a lot of volatility and a lot of movement actually didn't go much farther, but we've seen other markets like gold or oil, which actually moved a lot. So we are going to have a look at them. Under the economic calendar perspective, well, we are still under a government shutdown, so no news. Although remember, the CPI for September will be released next week on a Friday. I guess should be October the 24th. It should be a Friday. Just let me check. Yeah. And after that, we are going to have, we are going to approach the next FOMC. So rate cuts and all the rest. And we're going to enter, we already entered this week, earnings season. We have seen a few banks actually reporting, a few of them a bit disappointing, I'd say. But, nonetheless, as for banks, there would be a whole different conversation with the regional banks, which seem to be in trouble once again. We've seen over the weeks Tricolor and then another company, brands something, but still involved in these subprime auto loans. And then on the top of that, a company went bust, and the subsequent bank went bust. It was Zion, I think, and then there was Jeffries. And it turns out that, to use Jamie Dimon words, where there is a cockroaches, there are usually more. It was a problem of collateral and rehypothecation of collateral. So basically, you take out a loan, you put up the collateral to guarantee that, but at the same time, you take out another loan, posting the same collateral. So what happens is that when you are insolvent, those two lenders, which were counting on that collateral to, be paid in full in case you weren't able to face your obligations, they find out that other people have a claim on that same collateral that they have taken for granted. So those money back are not granted. So again, it's a little bit of a problem because it creates risk aversion in the credit market, and so you could get to a little bit of a liquidity crisis. But I think it's not really escalating that much for now, but it could, right? It could. So let's just monitoring it, right? Now, after this brief overview and introduction, let's jump right into the charts and let's see what happened, all right? So jumping into the charts, let's start out as usual with the DXY, which again, it closed last Friday with a little bit of a rejection here. Then it tried to rally on a Monday, and Tuesday, Wednesday, it was pushed down. So we had a little bit of a pullback in here, considering this impulsive move to the upside. We also came in, in contact, or came in to test a previous high, like almost to the T, if you check the higher apex, which you can't really see in here, but if you zoom in, this is just looking like an apex, all right? And what do? We just draw back the impulsive leg to the upside. Now, it looks like for now, at the very least, we found a bit of support off of that previous point of release. We are going to make it dashed just in case, right? Until we bounced off of it. So next week will be critical to try to assess if this overall up move or leg up actually, no pound, but have legs, and we can keep on pushing after this bounce to have some sort of an efficient price movement to the upside, or if we fail this bounce and the DXY gets back to be stuck in this range which has been basically predominant since May at this point, right? Whether you believe it or not, the dollar didn't do a lot after the huge drop, one of the biggest drops in a 1 year time frame on record, by the way. So as for other currencies, naturally, what we've seen is the euro came back into this level we were looking at last week, and it took a few days, but it managed to put together that bounce. Now that bounce, of course, was on a Friday rejected where, well, at previous resistance. So as you can see, when you start to have a distribution like this, so market comes down, throws back, comes down, throws back, comes down, throws back, and since the market closed on a Friday, we don't know how this thing will go ahead. But I think the best for euro right now and other major currencies, conversely, but it could be to be stuck in this range in between previous support and current developed resistance. But naturally, if what we kind of described for the DXY, therefore the up leg being confirmed, turns out to be true, you will see the euro keep on coming down to crashing this old support and probably targeting these lows at and around 114, right, so to speak. I mean, you could basically apply the same logic for all the others, like the pound in here and the JPY. So again, sharp drop, pulls back. So now we'll see what's going to happen. It looks a bit weak, right? Especially compared to, say, the euro and the British pound. And if you paid attention, there were news coming out of Japan, mostly from a monetary policy standpoint. So it looks like they're gonna completely reverse the monetary policy that they had for the last 2 decades, maybe more. They actually announced that they will start to unload ETFs off of the central bank balance sheet. Whether you believe it or not, they were at that point where not only they were buying up JGBs, so government bonds, but they were also buying up stocks and equities ETFs. So just for the sake of reminding that when you think about the Fed being kind of aggressive or kind of manipulating or interfering with the market, if things keep on going the way they are over the next, 7, 8, 10 years, would you be so surprised in finding out that the Fed is doing what the BOJ has done for 15, 20 years? At this point, I think the time for surprises is over. You should just expect the unexpected, right? But moving along, the Canadian dollar, it's really weak in this junction. And again, we have been observing it drawing back completely and actually developing what it looks like on a daily time frame, a little bit of a downtrend. Now, look, if you zoom out, it's still basically in between this upper fractal right in here. And currently, it was held by this one right here up until the point it was in this range. But it looks like it broke to the downside. So what next? I think, best case scenario, it keeps on drifting up until the point it found a new balance in between this range. So in between 142 and 140. Of course, the numbers are kind of upside down because the chart is inverted, right? Because you have the dollar, which is not at the denominator here, but it's at the numerator, right? Just remember that. But yeah, that's I think the best case scenario for dollar Canadian. Swiss franc keeps on being strong. Absolutely. Still, you see going around that safe haven trade, even in currencies, which is kind of the reflection of what you're looking at in gold as for the broad market in general. I think a lot of people now came up with the term the basement trade, which, it wouldn't be me if I wasn't skeptical about it. Not about the trade itself, but about, the definition of the actual implications. But it's really too long of a topic. Maybe I could hint at a few other things later on when we are looking at gold, but don't expect much because it would take at least 30 minutes to just scratch the surface of the dynamics at play there. All right, let's move on to the other basket of currencies that we usually check. So the Chinese yuan, after the drop, it came back. It's trying to put together some sort of a dealing range at these levels. So, for me, at this junction, nothing really, interesting in this one. Same for the South African Rand, which is still overall still going up, maintaining this bullish posture for now, at the very least. And again, the India rupee, it got a little bit of a bounce because there was an intervention off of the Central Bank of India. I quite honestly, again, this is another thing I'm skeptical about, because we've seen these foreign central banks interventions, like we've seen them in Korea, we've seen them in India in the past, we've seen them in China, and we know that more often than not, they just last so much. They don't actually impact the market over a longer period of time, and other factors will just take the driving seat and bring the currency where it needs to be going by market laws. And at the end of the day, central banks, they are important, they can impact the market in the short term, but my view is that the market is always right and is always more powerful than even central banks. Brazilian real put together a bounce after this sharp drop. The ruble, do you remember we were looking at the ruble and saying, this is now resistance? So we have a sharp test into it, and we got past the previous resistance level, but we still find a little bit of a opposition, so to speak. It's still the same area. It's still this is type of apex right here. But, this time around, we tested back into the point of release, which broke out and confirmed the apex as broken. We'll see, right? But it's still interesting nonetheless to see that these price signature can always offer you some sort of a reaction, and therefore a trading opportunity, if you want to call it that, right? So let's move on, and we are gonna look at crude oil. So again, this one, it's kind of, at the current moment in time, for me, it's still kind of simple to assess. Last week we were looking at a drawback into the previous support level before actually going and testing the lower support, right? Which was right here. And, we said, okay, so if we were expecting a bounce off of this area, we would have preferred to see the market dropping into it without actually pulling back ahead of it. Now, the conclusion was, since the close was here, right? Can this one bounce? Yeah, it can, but, upside would be limited at that point, even if we bounce. So turns out it tried again to bounce Monday open, but it was immediately smashed back down below what was, expected or anticipated support. So what now? I think this is one of those periods or moments where you need to tame your horses a little bit. And, although you might retain, as in my case, some sort of a bearish bias on this one, just remember that, in the span of 2 weeks, if we just count the trading days, and if we discount weekends, of course, because the market is closed, but we came down something like, more or less a good 12% or something like it, which again, even for a market which is particularly volatile, especially in this period with all the global and geopolitical turmoils, right? Even for a market like this, 12% in 2 weeks, it's kind of a lot. And we are retesting back around into these lows right here. So, I think in the very short term, it would be so crazy to expect a bounce off of this region. The perfect scenario would be if we can actually test back into it, maybe with a little bit of a under over, if you want to call it that. Like, we try to bridge them, we immediately get back in, and we put together a sharp bounce. Now, at that point, you might say where the bounce could reach back into. Well, of course, previous level of people call it. I mean, I used to call it a bit less nowadays, but I used to call it your FTA, so your first trouble area. It would be back in what was deemed as anticipated support, which failed. So now you would naturally expect to be confirmed as resistance, kind of like in here, right? Support, 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 breached, tested back, now resistance, price goes down. So if we put together a bounce in here, it is a tradable type of movement because, 55 back up to 58, 59. It's a tradable move, even intra-week. But, just make sure that you take profits there, right? At least a portion, right? Does it mean that just because the setup is present, it's going to unfold itself? No. I mean, obviously, you could see the market completely breaking through and keep on going, right? Now, there is a point where if this market drops too much or too fast, there's probably going to be some sort of an intervention, right? I don't know if it's going to be the US government. I don't know if it's going to be the OPEC Plus or who have you, but I think, although Trump wanted and announced that he wanted lower oil prices, I mean, he got them, right? But I think there's a point where something needs to be done, because otherwise you're going to have major US miners and refineries and all the rest, the entire energy sector, which is going to struggle like a lot. And I think there is still a balance there. You might say you want lower energy prices and lower gas prices, but then if price gets so low that it's not convenient for these companies to keep on mining, what's going to happen is that either they're going to, cut production, right, to bring back price at a level which is, where it makes sense to actually extract oil, to dig oil out of the ground. Or, I mean, another thing they could do is they could cut jobs in order to retain their profit margins, even at this price level for the underlying commodity. But in that case, of course, they would impact the labor market. So that's another thing that even if you are Trump or if you are whoever in the States, you don't want to see that, especially in this situation where the labor market is already stressed enough, or at least it's showing signs of weakness, right? As Jay Powell remarked, like many times now, right? He finally realized, right? But again, that's another story. So I think those are the two potential scenarios. Either we, briefly and shortly breached the support, and then we try to reclaim it immediately, some sort of a swing failure pattern, and it gives you a tradable opportunity. We crack or we smash the support and we keep on going down. Would you have a scenario number 3? I mean, not really overall, but it's kind of the same type of logic we were looking at in here, right? So the swing failure, yada yada type of scenario would be much more likely if we straight out on Monday, we dump into the level, right? And then we try to get back up. In the case that, again, we bounce on Monday and we retest back into this one, then again, you have a potential opportunity to short it back into the support. Now, again, it depends on you. You could take profit a bit ahead of it, add it a bit below it, anticipating some sort of a swing failure. What I wouldn't suggest is, let's say you get into the trade like this. And as a general rule of thumb, this could be any other market, right? This is just a technical discussion at a point. Just it was a nice example in my view. So what I would discourage people in doing is, let's say to take the trade, to take the short, let's say in here, right? And then just because you see that the market, it's gaining velocity, it's gaining speed into the level, just don't fucking revise your target, right? If you have a level, again, it could be a little bit ahead of the lows, at the lows, or slightly below it. Just don't revise that target, because what could happen is that you have the target, let's say in this region, right? But then you see it's really going fast. It's just plunging. And you say, you know what? I mean, this is kind of an interesting point. It's a critical low. If we breach it, that opened the gates for a much larger move to the downside. So I I get greedy a little bit. I get ahead of myself and I want to try to go and ride it. And what could happen and what almost always happen is that the market gets right where you thought it would have gotten, and immediately and quickly reverse, coming back up, stops you out, and then maybe it really plunges, right? That's just the way it is when you have relevant lows like this, something so obvious that anyone and their mothers could see. If the market reaches the level quite impulsively with volatility, you oftentimes get some sort of a stitch up, right? It's just a good liquidity pool because it's going to entice market participants to get in, right? Those which are already short, as I said, might try to revise the target, getting a bit greedy. Those who want to try to go and long it will try to long it, as I was describing it, with a little bit of a, under over, right? Just as soon as it reclaims that. And so all the shorts, which didn't take profits or, God forbid, are actually trying to short the breakdown, they're going to be caught offside and they're going to be liquidated, or at least, they're going to be forced down of the shorts, and therefore the market will bounce impulsively, right? So again, just make sure that whatever you do, you have your trade, your setup planned in advance, and you stick to it. And again, if it goes, right, let's say you follow my quote unquote advice, and then actually the market goes, right, and you say, fuck, I closed right here, look how much is going. Just be patient. Because again, what would most likely happen, and it might take a few days, it might take a week, all right, but the market, sooner or later is going to get back into the level and offer you another occasion to be short again. Just at this time, you already have those money that you realize from here to here in your account and banked. So you're not taking the chance of giving back profits to the market, right? So that would be my advice. Now, after these tiny little parentheses of technical analysis or trade setup on oil, let's move on to gold. So let's have a look at gold. I mean, yeah, it kept on rallying. It looks like nothing can really stop this trend, although, especially this week, it just, I think it just got ridiculous. From Monday, Tuesday, Wednesday, it just went up. And I think, again, we were looking at it in the past, especially on a monthly chart. And of course, monthly charts, they take a lot to actually play out. But even on that type of a time scale, this market, it's really hot, maybe too hot. It was getting into levels of 2 standard deviations from long-term moving averages. So, at a point, I think this market will give in. Now, again, I've had these discussion right the other day. Oh, maybe it was yesterday. My memory on a Saturday morning, it's not that performing. But look, considering the impulsiveness of the move, would it be unusual to see some sort of a pullback? Considering that we didn't have a lot of kind of real pullbacks since basically here, and it was at the end of August. At a point, this market will need to pull back. The question becomes, will that pullback be in the top? I guess it depends on how you define a top, right? Because, if you're looking at it in the very short term, right? For you, maybe this market going like this, getting back down and getting back, let's say, into this, let's call it a support for now, just for the sake of it, you could define it as a top. While, some other people could say, well, it is just a pullback. We come back into it and we resume the upside. So this wasn't a top. This was a pullback and another buying opportunity. So it depends on how you see the market, not only structurally, but most importantly, in this case, I would say on which time horizon are you looking at? Because look, Christ's sake, even when you zoom out like this, right, and you look at this market, there could be someone which is maybe trading the weekly or monthly chart, which going to be able to tell you, look, if this market drops 15, 20%, this is a market I want to buy because this is just a pullback in the overall grand scheme of things, right? So I'm expecting this, for instance, right? So again, I think, having discussions is always useful. And I mean, I would actually encourage people to discuss, because if you don't discuss, if you don't face other people's opinions, how can you grow, right? But just bear in mind that different opinions might be derived by different time horizons or perspectives, right? And they can both be right? But it just because they are built up under a different perspective. So that's the point. That being said, getting back to the very short term, now on a Friday we had a little bit of an exhaustion, because as you can see, the market opened above the previous daily close. It rallied a little bit and it got exhausted real quick, and it spent the rest of the day getting back to the downside and pulling back like a lot. Now, it tried to bounce at the very end of the day, and it's much more evident if you go like this, let's say. But again, not really strong. Also because, again, Friday's close, liquidity starts to die down and all the rest. But just for the sake of it, do you remember when we were looking at this market? It is some sort of a deja vu, I guess. But it was actually last Friday, right? Because last Friday we closed into here, right? So a sharp drop on a Thursday, and then Friday started to try to get back into balance and to retest back into the resistance. So now I would just say it's the same type of approach. Maybe it was evident in here on a 4-hour chart. Let's just try to zoom in on an hourly chart, right? And again, just discard all the the opens and all the rest, because they're not really relevant on this one. But let's try to go like this. So this was last Friday, right? So you see the market, in this case, getting back into a previous pool of liquidity, or at least taking out a lot of washy price action. Like in this case, that was the washy price action, because all the liquidity which was present in this dealing range right here was already taken by the market going sideways into it, preparing itself for the up move, right? Now, the market traded just below it, as you can see in here, right? Just as median, it doesn't have to be a lot, but it just needed to find the next pool of liquidity below it. And then it got back into balance. It drifted to the upside a little bit. Now, you would have expected a bit of resistance at this level, which we had, right? The first reaction in here was good, but then again, the market kept on grinding up until the point it broke to the upside. So I would say the setup, it's kind of the same in here to some degree. Of course, it's not going to be exactly the same, because we are not looking at, copy pasting type of action, but we are looking at fractals. So we are looking at, patterns of sub-similarities repeating themselves over and over, right? And in my view, the way you could look at it is that, again, even in here, right, you see the market staying relatively quiet in here, going up, coming back down, and then really going to the upside. We get back. Now, we know that the liquidity which was present at this level was already picked up in here before fueling the run up. So if you see a drop, it's natural that we will need to test a bit lower. And forgive me if my lines are not actually very straight right now, but you get the gist of it. So we test back in here. Now, this level already, I wasn't expected to actually hold, but, in the end, it actually did. So at this point, what you could do is kind of the same. So if this market is actually able to put together this type of a grinding action to the upside, and of course, we might have a few levels which could offer up initial resistance like this one and probably this one, right? But again, although we might find initial rejections at this level, if we keep on pushing and grinding, I think when we get back into this apex right here, so when we reclaim these, and therefore these, I think at that point, at least the odds, no certainties, of course, only probabilities, but at least the odds for continuation would be on the chart, right? But, on the contrary, if you see this market being rejected right in here at first pass and getting back to the lows. At that point, I think, there was a lot of build up in here, another supplementary pickup in here, this sharp test into it, which led to a sharp bounce. If the bounce is not enough, at that point, you might say, okay, you know what, this market needs liquidity below it. And where the next level of liquidity might be, you might ask. At first glance, I would say, again, this is an hourly chart, so maybe in here, but I would deem it good maybe for an intraday bounce and nothing more. I mean, for intraday bounces, you could find a lot, like even this one right here. But forget all of this. If you want to get back to the higher time frames, I would say, yeah, I mean, there's a lot that you could rebalance back. Maybe, I mean, before getting to this type of real shelf that you have in here, but before getting there, I think even something like this level right here, it's kind of a price pause before the market really started to push. It could be a level where you might have a relevant bounce on a much larger time frame, but you're gonna have to assess it in real time. So, conclusions: this market, it's getting a bit ahead of itself. It would be healthy, at the very least, if you're not really betting on a pullback, or maybe on the other side, you're actually waiting for a pullback because you want to add back positions or actually initiating longs. I think, at the very least, if you don't get it, even going for a few days sideways, it would be healthy, right? So I guess we'll see. There are news, beyond the simple charts. There are news coming out of gold, and just considerations more than actual news. Like one would be this, right? And of course, you heard the retail investor, the plebs, which is, I know is a bit derogative, but you would be surprised to know how many derogative terms are used in day traders charts or Discord servers for what matters. It's if you're not used to it, it's really a word on its own, and it looks like many times people are kind of rude or offensive, but really it's not. It's just the way we talk more often than not. I think mainly because we are just kids. Sometimes it's funny to talk dirty, right? A little bit. And sometimes it might be because, people just need to vent out a bit of stress that, of course, is going to accumulate itself throughout the day and throughout the week. So sometimes having that type of abusive language might help you psychologically. I mean, I don't know. It could be many different reasons. Or it could just be because we are rude, period, right? But again, you should have a look at what day traders actually say and how do they talk to each other. And at the end of the day, no one is offended. That's the beauty of it, right? But another little parenthesis. Now, look, it looks like gold is going mainstream. So I was reading about people standing in line in countries like Australia to actually buy physical gold, which of course usually it's a topping signal, right? Here they are just saying that it's the most crowded trade that people are looking at. Although, look at this. Meanwhile, 39% of professional investors don't own gold in their portfolio. And the average investor allocation is just 2.4. So near all-time low, all right? So again, we could have a lot of ebbs and flows in the market, but is it really that type of euphoria you would expect? Because look, I've heard this type of logic and argument for Bitcoin, for instance, and we're going to check Bitcoin in a minute, but if it works on one asset, why couldn't it work on the other? Like Bitcoin, they're going to tell you, now this is not a top. Look, the level of euphoria, it's not at all-time highs. You're not getting Bitcoin news when you turn on the TV in your living room. You don't get your university friend calling back to you saying, how can I buy this thing, right? And if you check even on-chain data like the open interest and whatever, it's really not at all-time highs. Actually, we have just seen the biggest liquidation in history. So how can it be, the top? Okay, so the same logic would apply to gold, I think, right? if the average investor allocation is just 2.4%, I mean, it's not like all the portfolios in the world are allocating like 10, 15, 20% into gold, right? So, I mean, is there really a gold mania or a gold fever? I don't know. 40% of professionals, at least again, standing to the survey, we need to give the survey the weight that it deserves. But, right, just follow the narrative here, right? I mean, I don't know. Is it? It might be the most crowded trade from the standpoint of the counter value, the notional value which is put into it. But I mean, psychologically, I'm not really seeing like a lot of euphoria. It might be just me, right? Again, trying to be honest, it might be just me because I actually own gold, so. Maybe, I'm trying to have this inner dialogue with myself. Am I biased? Of course, I would like it to keep on going up, but usually when I'm into something, especially when it goes particularly well, I start to get particularly pessimistic because it's like, it's like in real life. When you have something which is going too well and it's unusual, why am I so lucky this period, right? I wonder when the next turn will come, right? Because usually it doesn't last. It's kind of the same, but although I'm trying to find reasons for gold to reverse on a macro scale, I'm not really finding them, both on the technicals and both even on these allegedly bearish or top signal type of news right here. And again, we can go ahead and look, gold ETFs, right? 2.1 billion just last week, right? So the 7th consecutive weekly inflow, all right. So it's a record, of course. But again, if it was another asset, like if it was an ETF on the stock market or a technology sector, I could have told you that this is something which is worrying me. The thing that, okay, you might say retailers are always late to the party, which again, the last 2/3 years of markets, especially in equities, confirmed that dumb money actually outperformed smart money, right? But even if you believe that, I would say, okay, it might be true, and I'm not discarding it at all, but I'm saying gold, to some degree, it is some sort of a different beast. It's a different animal, in my opinion. And again, I hinted at that in the past, like 2 weeks ago. This huge run-up, it's basically fueled by central banks trying to de-risk or to diversifying their risk, right? So you see what the US government is doing. You've seen what they've done to Russia and Russian assets, right? So maybe it's time to diversify your reserves. And so I think, especially I read this week that Poland actually was the central bank which bought the most over the last 2 weeks. So even if you think the retail and the ETF inflow story, those central banks are keep on buying. And, the Western part of the central banks didn't even start it yet. So what's going to happen when, let's say, like we see this case, Poland is bidding. And then maybe after that, maybe it could be Germany. And then it could be Italy. And then it could be the Great Britain. And then it could be France. Then it could be Spain, right? I mean, I think if these things really escalate, the geopolitical risk escalate, central banks, they don't care about the price. They just want the underlying, right? So I don't know. I think there are still reasons to go up. And it might get particularly volatile, right? But overall, in the long term, so let's say from here to maybe the end of 2026, at the current moment in time, I would say gold will be higher than how it is right now. So that would be my point. In the short term, like next week, could it drop 10%? Yeah, absolutely. And most likely, depending how it drops, I would be there buying. All right. So, but again, we'll see, right? Look, this is another one. From a technical standpoint, these guys are just highlighting that the RSI, it's as high as it ever gotten. Okay, I mean, that would suggest overbought, but, although I'm not using the RSI very often these days, in my experience, the best use of it was for divergences. So it would be, and again, this is a monthly time frame, right? So just remember that. It would be like, okay, maybe it pulls back for a month, considering that it went up for what, 1, 2, 3, 4, 4, 5 months up only. It pulls back for a month, and then, the RSI gets back, a bit to the downside, just a tiny bit. Then we have another push, and on that push, we actually create an RSI divergence. And that is where I would like to be on the high watch for a potential macro, monthly time frame macro reversal. But, before that, I actually don't know. Yeah, in the short term, it might be good for a pullback, but in the long run, I don't know. I mean, I know I don't think so, right? Okay. So, and then this is the story of silver, right? Look at silver when actually nuts. And if you read that, it's actually crazy what's going on. I think it's been since the 80s that we didn't see something like it. There was a part where they're actually shipping cargoes across the Atlantic because in London, you don't have enough supply to meet demand. Yeah, look, as a result, investors are booking cargo flights to ship 30 million ounces of silver from New York to London to profit from record premiums. So, I mean, there is really if you thought there was a gold fever or a gold rush, what about silver, right? Getting back for a little while to the technicalities of it. Now, this is the gold to silver ratio. Now, if you just check the ratio, it looks like right now we are back to support. Now, usually or at least, in recent times, what happened at support? Well, let's try to zoom in so that even the chart below kind of get in line, right? What happened at support is that, of course, you got, it is a ratio, so obviously you get gold, which gain back strength compared to silver. And if you check over the last few weeks, what we've seen is that the ratio actually came down very sharply because silver, which is obviously in gray in this one, right, catched up with gold and actually basically surpassed that. It went up even more, right? So obviously the ratio went down. If you check back when the ratio gets to these extreme lows, what happened is that there is a short-term top, mainly in silver, right? As you can see in here, right? And, it doesn't tell you a lot about the overall direction, but it just tells you the relative strength in between the two. So I don't follow the silver market a lot, and obviously I don't have positions in that, but I don't know. I would be on the high watch for a top in silver, which again, it might be, maybe we have a short-term top in gold as well. Well, maybe, could be. Although I do think it's more gold which drives silver than the other way around. Like, even in here, you see that silver just catches up. On a larger time frame, right? Now, in the past, what we see when these ratio drops sharply is, of course, silver catching up. And again, if you check the chart, when you got these extremes, is usually a top signal, right? So gotta be fair, gotta call it spade to spade and saying, look, in the past, when we got this type of behavior in the ratio, right, that was more often than not a top on both, right? So, of course, then with different relative strength, but they are both put it in a top. Is it a massive reversal? Well, I mean, not necessarily, but it just went sideways for like 2 years. So, something to keep in mind. If you go back in the past just a tiny bit, what you see, even in this one, is that, when these ratio gets to extremes, like in this case, you had, silver really spiking, right? And then it just put in the top. And short after that, gold did the same and it puts in the top. So, I mean, whether you're looking at these to the upside or to the downside, just remember that when it reaches into extremes, something, at some sort of an inflection point, it's most likely about to happen in the two underlying markets. So therefore, both gold and silver. The ratio itself, of course, it just tells you about the relative strength in between the two, but it doesn't tell you a lot about, the overall direction. Although, again, at extremes, it might signal inflection points in the market, right? Let's have a look now at Bitcoin. Bitcoin this week, it tried to rally. Spot tried to rally on a Sunday. On a Monday, it put in this type of a doji here. And the rest of the week, basically Monday, Tuesday, Wednesday, it was all down, right? Now, look, it wasn't the cards, right? If you remember the squiggly lines from last week, a retest around the lows was kind of on the bingo card. There wasn't a lot. I mean, I wasn't particularly, I wasn't biased one way or the other. I just highlighted 2, maybe 3 scenarios that could have played out. And depending on which one comes first, you might infer something for the future. Now, just when, it was just a week which went by. So obviously we got the retest of the lows, but I think this is the point where you need to kind of see what is going to unfold from this one. Can we at this point put together a bounce, or do we fail? So this is, I guess, next week most likely will be kind of pretty much telling for what Bitcoin is going to do. Obviously, if you just look at the chart like I'm doing, I do trade price action, right? For me, price is the most reliable signal when it comes down to market generated information. So at the current moment in time, my short-term bias should be bearish up until the point we don't at least reclaim this high right in here, right? Or, preliminarily, maybe even this one, right? Let's say, it's kind of the same that we were looking at on the hourly chart for gold. Like, we reclaim that, right? And we are able to get back and trading into this range. And you should at least, in my view, at least shift from bearish to at least neutral. And considering how Bitcoin is performing on a much larger time scale, at that point, I would say the odds would shift slightly to the upside, or, you could get back to be tiny bit more optimistic maybe. But again, it's another one of those weekends where I'm going to say, I need to wait and see. Just, this week didn't give me a lot of insights in what could be. And it's just a matter of safety for me. Like, again, what did I tell you last week? This is not the type of drop or the type of dip that I would buy. Mainly because I don't like this type of volatility to enter the market. I would prefer it, to have a different type of a signature, right? But mainly because, again, as it was put in the card, usually when you got this one, which is coming off of a cascade of liquidations, the market will need to find back balance. And yeah, it's good for a short-term trade if you want, like we discussed, but I wouldn't put on risk for, the medium to long term at this junction, because again, a retest of these lows is actually quite possible. So I might wait to see how price develop itself, even, intraday or on a lower time frame chart, and then maybe trying to add while you see price manifesting the behaviors that you would like to see to shift to bullish. And at the end of the day, maybe you didn't buy the low, but again, if you start seeing the market kind of, going like this, being unable to break the lows and starting to reaccumulate, it doesn't really make you a difference if you buy the absolute low right in here, or maybe if you buy in here, or if you buy in here, or if you even buy in here, right, on the reclaim, right? That doesn't make a lot of sense in the grand scheme of things. I don't believe it does. So for me, this is an unnecessary risk trying to catch knife like this. I've seen too many people hurting themselves, myself included, up until 3 years and a half ago. So fuck it, right? Now, let's just have a look at this. We were looking at the Coinbase chart last week just to highlight the difference. And we were looking at the fact that Coinbase, so obviously or allegedly with a bit less leverage compared to your Bybit, your BitGet, your I don't know how many exchanges there are out there these days, but you know the drill. It came back, Coinbase came back into the previous area of support. So this shelf right here, all right? And it bounced. Now, though, I mean, we're still kind of there, but I mean, to me, it's getting particularly weak. So I don't know. Here, maybe another level of a bounce, because could you just try again? Look, I'm gonna tell you just a brief story, right? It's more of a joke, so to speak, and I know Roman will be listening to it, so it's gonna be funny. Every time this market dropped, at least recently, right? Like the most recent event, it wasn't here, right? There was just one drop, second, third. And every time there was, my friend was posting this tweet, which again, I get it. It's most of the times it's just for fun. It's just for the friendly banter, right? And about that was a strategic dump orchestrated by XYZ to shake out weekends. And the joke was, all right, that was the strategic dump, right? What about this one then? This is getting even more strategic now, right? Oh, look, another one. So if you bought the first one, now you're down what? Oh, nice, you're down another 5%, which in this market, considering the liquidations that we've seen, it means that if the market goes down 3, 4, 5%, you're basically out of the positions because all these knuckleheads are taking on positions with 10 to 25 to 50x leverage. God knows why, but they're doing it. Now, I'm not saying my friend is doing it. I actually know for a fact he's not, but it's just, sometimes it's not just about you, right? It's just about what the market is doing. And if these guys are so fucked to keep on trading the most volatile assets of history with that sort of leverage, I think they just brought it upon themselves. There's no other way around it, right? So in this case, you got the first drop, huge cascade of liquidations. All right. It looks to me like we already had the second. All right. So would it be crazy to believe that, we might have a bounce, especially Saturday and Sunday, and then Monday, Tuesday, what we get is another drop for the third, very strategic, orchestrated type of, stop hunt or whatever you. And then finally, when all these guys which bought in here, when they all give up, that's really when someone with really deep pockets, which actually bought these two dips right here, building up positions, it's going to be, okay, you know what? Now it's time to go, right? So just a tiny quick consideration on the back of the jokes that we usually make in between each other throughout the week. And yeah, so again, I think it wouldn't be unusual just because this level, at least on Coinbase, is untested so far, right? Again, probabilities, not certainties. It might not happen, but it would be something to look for. Let's have a look just for a brief minute, since we are just discussing charts. There is not a lot of economic news and shit, but let's have a look at the futures for Bitcoin, which actually traded particularly well. Look, every previous structure, support, or pocket of liquidity was tested, and it responded particularly well. The point might be now that, these last type of anticipated support right in here, offered up the initial reaction, but it was quickly faded. We also put together a bounce right in here, as you can see, at the kind of toward the bottom of the shelf, bounced and down again. And now, like on a Thursday, we closed below it. Friday, we rallied back into it. And, did we flip it? Because we were rejected. Now, of course, as many other markets, the week, or at least, Friday, closed on a bounce. Because, again, we were coming off this level right here. So there was this point of release right here, right? So that could be one thing that maybe provide another short-term bounce, but again, even here, I don't think it would be crazy to see Bitcoin coming, I don't know, 98, 96 before putting in a reasonable and mid to long-term low, right? I'm not saying it's going to happen for sure. I'm just saying, why not placing it on your bingo card, right? To me, it would make sense. Do we have any sort of a long-term type of trend line? Just for the sake of it, let's play this game. Okay, 2 touches, it would be enough for a trend, I guess. I mean, those were major lows, right? Yeah, pretty much. I mean, does it make a difference if you use this one or this one? Probably not. I mean, like this was the FTX liquidation, I guess. Wait, no. The FTX liquidation was actually in here. Gee, so you would have to come back in time even more than that. But do you have a trend line at that point? I mean, you could use this one right here, right? Touch, and touch. Okay. So considering the current pace, and let's make it in another color just so that you can follow it. Considering the current pace and posture of Bitcoin, and considering we got an untouched level right here, even on spot, where would they converge? Right in here. 97. So, I mean, in the grand scheme of things, right? Another cascade of liquidations, getting back kind of like in here. And then we might resume the upside. No? I mean, why not? Right? All of what we could have tested to the downside so far has been tested. So if you believe we are going to be short-term bearish, that would be where I would look at. It lines up with the trend line. It lines up with previous support, as you can see in here. And below, we got a virgin point of release in here. Does it have to be exact? Well, I mean, maybe it overshoots a little bit and it gets to 96, or maybe front run and it just stays in 98. But, you know, the region, just for the region, right? Since we are discussing some sort of a larger time frame type of chart, right? Yeah, so I wouldn't discard that type of scenario either. So again, maybe it's not, I mean, sometimes I think about it, maybe it's not that useful, right? Because it looks like, well, but you're never really saying what you think the market is going to do. Okay, I'm going to clarify it once again. Sometimes I'm going to get it right. Sometimes I'm going to get it wrong. But I think what is most important is not being right or wrong in and of itself. But, you know, again, be prepared, right? Come up with different contingency plans and then see if these and that. A, B, C. What do we get? Do we got 8? Sorry, A. Okay, if A, then I don't know, X. If B, then Y. Right? So and so on and so forth. If C, then Z. Right? So I think it's much more beneficial to be able to react and having different plans to be triggered and unfolded instead of just guessing. I'm not in the business of guessing, because over time I think it's kind of hard to be sustainable. But you know, of course there will be those times where you can kind of guess. As we said, like this region right here, was it good? If you want to play it for the bounce, sure. Intraday, intraweek, it was a huge trade. Does it tell you a lot on the overall direction? Well, considering how price behaved then the following week, maybe, like maybe not, because now you are kind of on your feet because you don't know. You bought in this region and price just got back into it. So how do you feel? And how do you manage that position? Do you keep your stop where it was originally? Do you move it to break even with the risk of being taken out and then the market just goes on a rally? Do you regret not taking at least partial profits on the bounce and holding to the entire position just because you were greedy? So again, you can play many different type of strategies and you can do whatever you want. Just be sure that you have a plan and you know in advance what you're going to do at different junctions, at different levels, if this and that, if this behavior fails, if this behavior is confirmed, and all the rest. This is the business, not only of an investor, I think, but mainly of a trader, a short-term trader. Right? This is why many times, especially in times of increased volatility as we've seen recently, instead of like I've done in the past, saying, I think my bias would be these. When the market gets volatile, I'm more on, I would play this level, I would play that level, and then I would see, right? I would wait for confirmation. I think, is it the best absolute way to do things? Not necessarily. It is just my own. I'm sure 95% of people out there are better than me in grasping the direction of the market, in managing their positions, in managing their sizes. Absolutely, 100% guaranteed. Right? Otherwise, I wouldn't be here. I would be managing an hedge fund. But do I want to manage an hedge fund, considering that most of the professional money managers are actually underperforming the market? Right? But different topic. But again, you got the gist of it. Let's have a look at the yields. Again, yields went just down. Same behavior as for gold, as for Bitcoin, and we will see the equity market. They drew back. They bounced on a Friday, but nonetheless they broke. Just the day ahead of it, they broke the previous lows. So it looks like at least intentions manifested were to further downside in yields, and therefore further upside in the underlying bonds and treasuries. Even in here, right, you can. It's very clear, right? We came back up. Do we call it for a swing failure pattern? On the 2-year, no, not really. But wait, is it really a 2-year? I think something is off. Like, this is a 2 years. This should be the 30. Am I missing the 10-year bond? There you go. This is a 10-year. This is a 2-year, and the long bond. Okay. So do we got some sort of a swing failure pattern on the 2-year note? It could be. On the long bond, not really, because otherwise, the catalyst for a reversal that was present before, like 1, 2, 3, and then finally we closed above it. So not really. 10 years, again, maybe a little bit of a pullback, but again, on a closing base, look, we got back into this apex. We pushed into it 1, 2 times, and then finally we broke through and closed above the previous closes. So I think, again, my mid to long-term thesis for lower rates and therefore bonds to come up a tiny bit, it's still intact. Although, you might have ebbs and flows. As I said in the beginning, we're going to see CPI released next week. So yields are going to move on that news for sure. Then we're going to have the Fed coming out with the rates announcement. Actually, let's have a look at this, since we're talking about the Fed, the yields, and all the rest. The break-evens actually plunged this week. So, could these be inflation expectations are even more toned down these days? Let's have a look at the PCE, 2.4. It came up just a tiny bit, but if you look at the chart overall, it's contracting. It's not expanding to the upside. The CPI, still in this range, 2.24. Yeah, okay, BLS reported 2.90, but we'll see what the data will be on Friday. CPI, we are still kind of on, we're still on the upper side of this range, right? So we'll see how the data will come in. GDP now 3.9, but it was updated on yesterday. All right, finally 3.9, which a bit too optimistic for me. If I consider it annualized, but Q3 could be whatever, right? But this Fed Watch, look at that. So another cut, it's basically taken for granted now. All right. But again, we have a 1%, which is again raising his ugly head for the 50 basis points cut. So, the market is expecting the Fed to cut. I'm curious, but that would be for December, right? What about October? It's kind of the same. And it's going to be on October the 29th. So, yeah. Not next week, but the week after that. Yeah. And then on the 10th of December, still. Wait a second. So, okay, October, 50 basis points. All right. And for December, down another 50 basis points. But you see that for December, the odds of a 50 basis point cut are increasing. I mean, it's just from 1% to 6%. So how much weight would you put on it? Probably not a lot. But again, just make sure that there is not a huge variation, right, in this data set. Because if you see the market starting to price in possibilities of the Fed being even more aggressive with cuts, I would take it as a negative at the current moment in time, because I think the market might have the ability to rally if the Fed it's decreasing rates slowly. Like everything is in control. We are just adjusting monetary policy. If they see that the Fed is actually panicking, the market will take it as, wait, the old man just lost control once again. What's going to happen now, right? So you might see a bit of volatility to the downside in that case. So just make sure that you don't see, let's say, the 6% becoming, 25 or 40 or 50, because at that point, I think there would be problems overall. And, a few problems might be in the credit market. Now, we had a little bit of an impulse to the upside, but it was quickly faded. And it might have been tied to what we were discussing in the introduction with First Brands, Tricolor, and then Zion Bank, and then the other one, which was Jefferies and all the rest. So these problem with collateral and with potentially liquidity and liquidity bottlenecks. On the topic, by the way, let's have a look at this one, for instance. So you see that, the reverse repo facility, it's basically drained at this point. And in a nutshell, because again, even the definitions are sometimes a bit confusing, because you look at the reverse repo from the perspective of the Fed, but you gotta realize that those two terms, like repo and reverse repo transaction, are inverted because they depend on the perspective on which side of the transaction you're analyzing. So this is called the reverse repo. It's basically where you can go to park if you are a financial actor, right? So you could be a money market fund, you could be a money dealer, you could be whatever. If you have access to the Fed facility, you can go there and park your excess liquidity. Because, at that point, at least it's not idling, but you can actually make some money, although marginally, but you can make some money. And it's also some sort of a tool that the Fed uses to prevent the Fed funds to move a lot. It should basically put a floor, right, below Fed funds. The bottom line is that if there are a lot of money in this facility, the general rule of thumb or the general assumption is that there is ample liquidity. Because, of course, the market, in case they need it, they can drain this facility, they can drain the liquidity out of this facility and cover their needs. If there is no more liquidity in here, it just means that all that could have been taken out of this has been already taken out. So if we have a liquidity shortage, where will the market or the financial system get that liquidity? You will need what? Another Fed intervention. And it could be through, again, getting back to QE, and we're already seeing that Powell already announced that they're going to end QT, right? Or it could be like in the case of the regional banks, like we have seen in the past in 2023, you could set up another special facility to take care of the problem. So is it a massive problem? I got to ask, is it a massive problem? I think, conceptually it should be, right? Let's say you see some other regional bank actually going bust, and the risk appetite in the lending business actually drops. There could be some sort of a crack in the funding mechanism overall, especially overnight, right? And not only for US actors, but for global actors. But it is also true that considering what we've seen, usually, I don't think a lot of those entities actually should have access all the Fed benefits, like the credit line, the bailout type of a mechanism. But again, we have seen with the BTFP that they just took the Federal Reserve Act of 1913 and they said, yeah, you know what, I'm just ignore it and set up this facility at this point because that's what I need to do in order to rescue the financial markets. Otherwise, the entire house of cards just crumble. So I could be something like it. But in just, as I testify that we might see some little bit of stress in fundings. So basically, this is the same chart as before, but overlaid, we got the SOFR curve. Now, if you don't know what the SOFR is, it's just the secure overnight funding rate, maybe. I already forgot the acronym. But basically, it is an overnight rate for overnight transactions and funding operations. There was a tiny little bit of a story there. I mean, SOFR is relatively recent. Ahead of it, we used to have LIBOR. There was a little bit of a scandal there. The LIBOR was, of course, not secured. And LIBOR was more on, it was more on a survey based. Like, what type of a rate would you apply if you had to lend money to XYZ? And different banks would have responded and they would have said, yeah, this, maybe that, maybe the other one. Okay. The accusation to LIBOR was that it was arbitrary and sometimes it was manipulated by these banks just, to play with market dynamics. The thing is that I think, SOFR is actually based on what transaction could actually go in instead of if you had to lend money to someone. The accusation was, well, again, but I could just lie and say, yeah, I would apply this rate, or yeah, I would apply that rate. And then, when I have to actually do it, I might apply a completely different rate. So the accusation was that it wasn't reliable and it didn't have any type of solid evidences in the real world, right? Okay. But I guess that's just the thing, right? I mean, think about it. You might have a bank which is telling you, I would apply that rate, right? And you might say, yeah, but they're never going to do it. Which in and of itself is, is an input. They're never going to do it. It means that at no rate, they're going to be able to extend credit, all right? And look, SOFR, if you would allow that it's actually based on transactions which actually took place, it doesn't tell you a lot about all those transactions which, although were needed because maybe someone actually needed to be funded or to refund their overnight or short-term operations, they actually didn't get access to it. So they are experiencing a credit crunch, but the data is not picking it up, in my view. So I think, it's a debate. It's still open. No one actually resolved it. But my take would be that maybe LIBOR, it was a bit better to get the pulse of the overall funding mechanism, especially overnight. But after that, another parenthesis, what you see now is that, of course, since there is less liquidity in this facility, conversely, the overnight rate is going up. And again, what is a rate? It's the price of money that you borrow. If it goes up, what does it mean? It means that there is more demand for funding relative to supply. So it looks like there might be some sign of stress in the credit market and in the overnight funding market. We'll see. I don't think that just because two banks actually went bust, I don't think it's enough. The problem is just, it's not really about those two banks. It's about the message, right? Because, again, where there is one cockroach, usually there are more. So if the other banks around are going to try to question, wait a minute, so this thing with collateral rehypothecation, I always butcher that word, rehypothecation, right? If this thing actually went on with these two banks, I wonder how many other banks could do that? Maybe I should dig into it. Maybe I should revise my entire balance sheet and look at how many loans that I thought they were particularly safe are actually not. If you start to question the collateral, if the lenders start to question the collateral, the inclination to keep on lending and therefore keeping the machine spinning is going to decrease. And if decreases, you get to a credit crunch. So that was the main problem. And I think, again, even Powell starting to talk about QT being ended, probably getting back to QE shortly. It's another telltale sign, together with the labor market weakening, that I think the Fed is actually seeing some potential risks, and they want to try to stay ahead of it and not repeating the 2019 debacle that we've seen. So that would be another thing for me, right? So we've talked a lot. It's incredible since we have just looked at charts. So now we're going to have a look at the stock market for another, 15 minutes, and then we will close down the video for the week. Okay, let's get back to the stock market, which, if you just look at the heat map for the week, I think I'm actually doubting that it is up to date, because I was looking at on my phone in the morning. I saw one which was posted, and there was a hell of a lot more green. Maybe it depends on how TradingView calculate that. I don't know. Maybe they just look at different trading hours or different closes or opens. So it could be something like it. So I think let's just move on to the charts. Now, we left the market with a huge drop. And of course, Trump immediately revised the statements. So now we're going to talk with Xi, and we'll see what type of a deal we can come up with. And again, then there was this problem with, First Brands and all the rest, and then Jeffries and Zion and all the rest. But the market shrugged that off. Although, obviously the financials didn't take it very well, as you can see. Right, so that could be another reason why overall stock market was down a tiny bit. Although it's also true, financials, had a spectacular rally. So it could be that on the news, someone decided just for the sake of it, I'm going to take profit. Right. But we started to bounce on a Monday. We gapped up relative to the previous weekly close. We used kind of like the region of the weekly open on a Tuesday, both on NQ, on the Dow, and to some degree on ES futures, to accumulate back again and keep on pushing to the upside. We had, as you can see, a little bit of volatility on Wednesday. Like, the market was up in the morning, which is, morning it's for me, like in Europe. So it would be overnight for US residents. Up overnight, down at the open, and then it got back into balance at the end of the day. Thursday, we went up and immediately sold off across the board, it looks like. Yeah, right. And then, on a Friday, the market really tried to put together this bounce. And overall, we got back filling in this drop that we had on Thursday. So kind of a volatile market, some sort of a true tape type of market. But overall, if you zoom out, you can see that we hanging there, right? Nasdaq looking a bit stronger compared to the S&P, but nonetheless, they're both kind of there. So we spent the entire week basically rebalancing out the sharp drop that we had last Friday. That was the thing. Now, I think to some degree, the lows that we have, again, it's kind of like the same of Bitcoin. It wouldn't be surprising for me if we retest them, and they would need to hold. Like, if you want to have some sort of a line in the sand, like these weekly low right here, it needs to hold. Otherwise, it starts to get real ugly, right? Not on a macro scale, but short term. On the other side, if we can get back and completely reabsorb the dump, in this case, right? At that point, we might say, of course, new all-time highs, and the market should keep on grinding to the upside. The range is getting really tight. So I think next week at a point, we're going to have some sort of a resolution into it, like moving up or down. This week, again, was just the market getting back into balance after the huge imbalance that we registered on a Friday. And other than that, again, I don't think directionally there was a lot. So shifting layout, if you remember, just keeping up to date with this dynamic right here, we played the divergence on the RSI, we played the cross on the stochastic, and of course there was a divergence on the MACD histogram. Now, I think, we left out this entire price segment saying, look, remember that we might have these moving averages cross looming, which was in between the 8 exponential and the 21. So we were kind of stuck in between support, as you can see at the 25, right, on both. But on the other side, we got the potential bearish cross looming. At the end of the day, with that huge rally that we have seen in the second half of the day on a Friday, we managed to save the market from that cross. And we are confirming so far the 55 in green exponential moving average as support, right? So it's kind of like what we've seen previously, if you remember. So it was back in here, right? Do you remember I was saying there will be some times where this market, of course, by the nature of averages being averages, there will be some times where the market actually, it's a little bit wishy-washy around these moving averages. But, as a general rule of thumb, up until the point you don't see the faster crossing below the slower, I think we are all good, right? So it looks like this is what's happening for now, right? We'll see what's going to happen next week. For now, up until the point things stay this way, I should maintain my overall bullish bias, which again, if you remember, ties in with Bitcoin, maybe taking another step to the downside, but overall, maybe trying to put together a bounce and following the rest of the risk on assets, right? Same as gold. If you check the yearly returns for gold and the S&P over the last 5 years, there is, if you just check the returns, so you make a ratio in the realized returns, right, the percentage returns, I think, gold performed a bit better, if I'm not mistaken. But anyway, the ratio was just 0.89. So basically, it means that overall, in the grand scheme of things, these are moving together. So if the stock market keeps on being bullish, for some perverse reason, I'm expecting gold to keep on being the same. But, just for some sort of intermarket type of relationship right there. Now, I think the risk now is that we can't really turn oscillators around, or maybe the RSI gets stuck in this neutral zone and the market just goes choppy, right? Which, look, if you are bullish long term, another week or two of market choppiness is actually good for you. There are two ways by which the market can correct and work out overbought conditions or whatever sort. One is with an actual pullback. The other is a correction through time. So market staying in a range and being choppy for maybe 2 or 3 weeks, 1 month. That's another way by which you can work off overbought conditions. And is in and of itself is another form of a pullback, right? Or you could also look at it like, the market will just go sideways, building up some sort of a solid base and eventually breaking out of it. But, it wasn't just a sharp up move, inefficiently delivered with no base to sustain that. But if we build up a base before and ahead of time, it could be a legit move to the upside. So all in all, technically, it's not a reversal yet. It is just a sharp drop, similar to what we've seen in here, right? At the end of July. And if you check back, everything turned out to be good. afterwards. It was generated on news, right? The Trump, Xi, 100% tariffs. But I think the market, the market just showed his hands. I think the market at this point, it's just shrugging those off. Like, the whole taco trade and whatever. Trump plays big, and then he has to pull back because, quite realistically, he can't deliver on 100% tariffs. Like, you already have what, 40% tariffs on China, I think. But regardless, if you bring 100% tariffs in, that is just like putting in place an embargo, right? What do you think is going to happen to both economies and therefore to the global economy if you have another global trade freeze? I mean, you don't need to be that old to remember what happens in those times. You just get back to 5 years ago when we got the COVID pandemic and global supply chains were shut down, right? Nobody wants that. China doesn't want that. The US doesn't want that. Nobody wants that. So I think at a point, either they keep on, negotiating with these, tools of carrots and sticks, or one side will have to give in. I'm not sure who's gonna win. I guess there is no way to know, in my view. I would say, no matter how much of a good negotiator Trump could be, I think you shouldn't discard the capability of the Chinese to negotiate at this table. They got a lot of stuff on their hand, right? Like rare earths. And although you might think that, the US market, it's of course very important for everyone, right? It's the major market, sole consumer market. So if you are like China, a country which produces a lot of stuff and you export, right? You need their market. It is also true that although Chinese exports toward the US actually dropped, they increased toward other trading partners. So I think the way China might play it, beyond the blackmails with the rare earths and whatnot, but it's going to be interesting to see if they got the ability to find new markets for their exports. I think it's a very difficult thing, but we'll see, right? And, other narratives or other things worth noticing, it could be this, if you want to check another ratio. So this is currently, as my phone goes up, right? Just let me mute it, all right? This is basically the S&P to gold ratio. So it's just, again, like we were looking at before with gold and silver. It's a relative type of weakness type of relationship. Did I say that correctly? I mean, it gets a bit hard when you talk for 1 hour plus in a language which is not your own. But again, it's just the same concept. So you've seen that these ratio is actually going down because gold is really catching up with the stock market overall. In the past, when we have seen this type of behavior, whereas the ratio actually starts to go down overall, like this, right? Or let's just do it like this, right? It goes down, right? Like this. For now, doesn't look like a lot, doesn't look warning, doesn't look worrying, right? Doesn't look like a warning. But in the past, when the ratio was actually coming down, let's say in this region right here, it comes down like this, it comes down like this. Look at the S&P. That was 2022, basically. Ahead of this, you look from 2018 and 19, and what do we have? If we zoom in on this chart right here, right? It was this segment right here. When we got, of course, the 2018-19 crisis, and then we got the COVID dump. So not a cool time for the stock market. Ahead of that, we got this sharp drop in here Which, I mean, again, even if it wasn't like gold was ripping. Actually, gold, if you check, it was kind of still coming down or hovering around the lows. But at the same time, the ratio was telling you that, look, it might be a period where the stock market, it's underperforming your expectations. And in fact, the stock market since 2015, 16, up until 2017, like this period right here, it was kind of boxed in this range. And then you see that when finally these ratio put together a bottom and it starts to go the other direction, then you see the stock market, the SPX in this case, actually starting to resume the upward trajectory. So, I mean, it could be something worth noticing. Just, I mean, is it a signal in and of itself? I don't think so, right? But because again, it's just relative strength in between the two. But you might use it as a secondary system or as a confirmation tool, right? It can't really tell you direction because, you know, they could both go up and down, but at different paces, right? But, you know, especially when you look at it, when it's making extremes and sharp moves, it could help you, again, same as the other one, with identifying inflection points, right? So with all of that, I mean, we'll see what the stock market will do. I think, first and foremost, I don't have any trigger yet to shift to bearish. Although, again, as usual, we have our still present type of risk, like margin debt skyrocketing, right? Or we have the household financial allocation, again, skyrocketing. You know, historically, it's not just the last 5-10 years. This is an historical chart. It goes back to the 60s, as you can see. They are launching new ETFs, and why not? If you thought 3x leverage ETF weren't funny enough, why don't you go to the next level? Just go with 5x. What's going to happen? I mean, I've seen my neighborhood, I've seen what's going on with all the other guys which are playing with cryptos with 20x leverage type of trade. What can go wrong, right? What can go wrong, bro? So fine, just buy and close your eyes, right? So why not bring in a bit more leverage into traditional markets too, right? Again, it's just a matter of speculation really skyrocketing right now. You see the record amount of ETFs inflows in the US, right? And look, call option volumes. Again, I don't know. I mean, if you do consider from 2008 up to recent days, a huge enough amount of a time span, but this is looking like a chart which is going parabolic. So again, the level of speculation, it's still outrageous out there. And again, it might go ahead for another 6 months, 1 year or whatever, but it just tells you that the amount of risk in this market, it's increasing by the week and by the month. Again, it doesn't mean that the market will crash next week or next month, but just maybe try to rethink your risk reward and think how it is evolving, right? Look, now, this was just a controversy. This is the Saturday of controversies, all right. You know, I mean, you might be familiar with the Fear and Greed Index, right? Which is created by CNN, I think. Looks like it. CNN Money, all right? Now, the problem I have with this one, which is currently, I think last time I checked, it was scoring 27, so kind of in the fear zone, right? In between the extreme fear and the fear. But look, those are, you know, the factors or the things which are used to calculate it. So you got the stock price, right? Okay. Stock price momentum, stock price strength, stock price breadth, put and call options, right? And they might use, I don't know, put to call ratio or something like that. junk bond demand, so they might use the spread, market volatility, so they're going to use the VIX most likely. The thing I don't really like about that is that they're using stock price momentum, stock price strength, stock price breadth. So, I mean, my doubt is that are they using the index to assess the stock market, and inside the elements which are actually being put together to derive to the result, they're using the stock market itself. So what is that? It's some sort of an index of the underlying index. Are you counting the underlying index 2 times? I'm not sure that I really believe this one, especially because would you expect with the market? Let's get back to it. Just to prove a point. Look, we with the market like what? That was the all-time highs. We are now in here. With the market at 1.30% shy of his all-time highs, would you expect the market to be in fear like a 27? So I don't know. It doesn't make a lot of sense. I think it should print a euphoria type of read, right? So if you go on this one, you see these guys, they came up with a different type of index, still measuring the same things, but as you can read, they're using different things, right? I mean, they might use something which is already in the CNN Money Index right there, but this should be the Association of Independent Investors, and so there are different metrics that they're using. And if you check, so these composite index, it's scoring a 70, almost a 73, right? So still greed. And, those, the elements of this composite index, the indicators are, equity allocation levels. So what action investors are currently taking. And, in these measures are combined in this index, which of course it ranges from 0 to 100%, and it is a contrary indicator. The point being that the thing that they're using, the factors are a bit different. And I think, just to credit these guys, the read that they're getting at, to me, it's a bit more representative of what the market is currently doing. All right. Now, I don't know what we're going to have next week as for the economic calendar, of course, because, still under government shutdown and all the rest. But, behind the fact that we know now for a fact that they're going to announce CPI, what else do we have? Nothing on Monday, Tuesday, no. Wednesday, nada. Thursday, I mean, again, initial jobless claims. If the government is still shut down, we are not going to get them. And now they're posting, of course, CPI. We'll see. Allegedly, we should have that, but we are not going to get probably PMI, of course, and a lot of other things. So I guess CPI plus earnings season, if I can. All right. Okay. Will be what moves the market. So we're going to have on Tuesday, Netflix. Wednesday, we're going to have IBM, Tesla. So, and on Thursday, Intel. So a little bit of a glimpse in what the semiconductor sector is doing. We'll see about that. I think, since we have been starving from economic macro data point releases, I guess earnings will actually take the driving seat now that we are really in earnings season. On a positive side of things, after earnings season is completed, we are going to get back into the corporate share buybacks, which should, bring in a bit more of support for the market, since we are going to add back in a major marginal buyers of equities. So even if we think there is going to be volatility in the inner room, just try to survive and see it through to get to the other side. And most likely, at the end of the day, we should hopefully see the end of the year rally, right? So let's have a look. At least let's keep an eye out for the earnings next week. Now, we talked like a lot. Absolutely. So let me know. And after that, I wish you a very good rest of your weekend. Have a good week and be ready for next week. As usual, be nice and be cool. We're going to talk again next week. Niels out.
Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Fat boys, duke it out. Hit him. Get the fuck off of me. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.